How are these high net income earners actually being able to get all of the money that they've withheld back, or get a lot of it back? They're doing what we call the short-term rental loophole. And in this video, I'm gonna explain to you in detail what the short-term rental loophole is, what are the requirements, and actually give you an example of a real-life client that we had, as well as making sure that you also understand what is the downside of doing this strategy that everybody is doing. My name is Anna, and I own a virtual real estate CPA firm where we help clients all over the country play the IRS game just like the wealthy do. This is one of the strategies that a lot of our high net income earners are currently implementing in their tax return in order to minimize their tax liability. So let's get right into what are the 3 steps that are needed in order for you to actually qualify for the short-term rental. So the first step is easy, right? You actually have to buy a short-term rental. That means like a vacation home that you are currently renting. Now, the number 1 requirement for this is that it has to be rented on average 7 days or less. So that means that those people that are renting to traveling nurses or corporate VPs or whatever you're renting, it's probably not gonna work, because on average, this short-term rental, in order for you to qualify, has to be on average 7 days or less stay. Therefore, it mostly works for people who are coming in, you're turning over the property, and you're moving out. Airbnb and VRBO do a great job of actually giving you the average of the stay of these guests. So let's recap. Step number 1, buy a short-term rental. Number 2, make sure that on average you have stays of 7 days or less. Step number 3 is to make sure that you materially participate. So what does this actually mean? This is a very important requirement by the IRS, and the one that can actually make you lose the court case if you get audited by the IRS. It is materially participating in your rental. What does that mean? That means that you actually have to work on the rental. There are specific 7 tests. You can pick from either of the 7 tests to prove your material participation, but we're gonna talk about 2, the 2 that are most used by our clients. If you want to materially participate, you can choose the following. You can either choose to materially participate by making sure that you have 500 hours or more spent in the rental property. So that means that you actually have to be coordinating with the guest, talking to the cleaning crew, talking to the furniture decor people. That actually has to be spent in the property, doing time in the property. So if you have a property manager, it's gonna be really hard for you to prove that you worked 100 hours or more. Now, you can also choose test number 2. Test number 2 is you have to make sure that you work 100 hours more than anyone else. So if it's you and let's say your cleaning crew, you have to make sure that you are actually working 100 hours more than not the entire company of the cleaning, but each person that steps foot in your property. So that means that if it's just you and the cleaning crew, you have to prove that you work 100 hours or more than each person that goes into your property. Now, if anybody here has a short-term rental, has ever dealt with one, you do understand that setting up a short-term rental takes a lot of work. So the first year, it can definitely be easy to reach those 500 hours as long as you don't buy the property on December 31st. That's where tax planning is really important, and you should have a CPA that actually works with you as a tax planner, not just in April 15th when you owe a lot of taxes. We help our clients with tax planning all the time. Now, back to the number 1 issue that can get you audited, and it is not keeping track of your time. Now, if you think about it, let's say that, Anna works at Chase, a full-time job, and I buy a short-term rental property, and I'm taking all these deductions, and you're gonna see in an example how these deductions are taken and the power of this, that it has to get a huge refund. The problem arises when there is an audit, and we have seen it with some of our clients. The problem is they do not keep track of their time. Now, that's what it literally means. It literally means having a time log of your time. So then when the IRS, or if the IRS ever shows up and wants to see your time log, you literally have, hey, here's how much time I spent on January 1st, here's my spreadsheet, and it is the one thing that will make you lose the case. So it is crucial, I can't stress it enough, that you actually keep track of your time. So let's go over an actual real example of one of my clients. They purchased a property in Denver, Colorado for $450,000. With their cost segregation, they were able to get a write-off of $109,000. But before we move on, we need to talk about what is depreciation and what is cost segregation. Depreciation is a phantom expense that is a non-cash expense, meaning it just goes on your tax return regardless if you want to take it or not. The IRS says, hey, if you own a rental property that is a triplex, you are going to get a write-off over 27 and a half years. Short-term rentals are depreciated over 39 years. So let's say you bought $1 million short-term rental. If you did not do a cost segregation, your depreciation would be about $25,000 every single year. But with cost segregation, what happens is a company comes into your building, and what they do is they start looking at the different asset lives. And anything that is under 39 years, you are going to be able to depreciate it, meaning take that deduction up to 60% this year. It's a really good example, like when you see people on social media saying they bought a G-Wagon for $250,000 and they were able to write off the entire thing. In 2022, you were able to do that because bonus depreciation was 100%. Unfortunately, this year it's 60%, next year will be 40%, and we'll see what happens with the elections and the government. But that's what cost segregation does. It takes a look at the entirety of the building and it breaks it down by different asset lives. That's how they were able to get $109,000 of cost segregation / depreciation expense. Now, they have additional expenses of $27,000 for running that property, right? Interest expense, taxes. Therefore, their total loss that they're going to be able to use on their tax return is $136,000. Now, let's see how that actually affects and what the benefits are on their tax return. This person is a single individual, like I said, living in Colorado with a W-2 job. In their W-2, they made $131,000. This loss of $136,000 flows to their 1040, which is their personal tax return. They get a standard deduction of $13,850. Everybody gets a standard deduction depending on your marital status. In this case, she is single, and it was $13,850. Now, that means she wiped out all of her income. There is no taxable income. It's, in fact, negative. So what she actually withheld in her W-2, she is going to get straight into her bank. And that is how actually getting money back, it works. Now, people are like, oh, am I gonna get any money back? It's like, well, whatever you put in is what you get back, honey. You don't get any more money back. But she's able to get this $18,000 refund into her bank account. Now, what she does with it is up to her, but your tax strategist should probably advise you to either rinse and repeat the process or buy another rental property. You do not want to take this $18,000 and go live it up in Europe, bottle service. That's not what you want to do. Now that you've saw the example, I want to talk about the downside of having a short-term rental, because it's all great and you saw the return and you might be thinking, this is for me, I want some cash flow and I want to get some refund. And it's all great. Here's my number one tip. Do not ever do anything because it gives you a tax advantage. Having tax advantage or a tax refund should be the cherry on top on why you're making the investment decision. And the reason is because I've seen it with people who wanted to actually do this in 2020. They were buying short-term rentals left and right, Gatlinburg, Tennessee, in Orlando, and they did not realize how much work it took. And guess what? They ended up selling the property, which cost them to have gains. So yes, they got a refund then, but they got to pay it back. So again, do not do something just for the tax benefit. The other thing is, if you are planning on doing the short-term rental, let's say this year in 2024, guess what? If you don't rinse and repeat the process, what's gonna happen in 2025? You're not gonna see that huge cost segregation depreciation expense because you've already taken most of the depreciation that year. So the goal is to make sure that you either rinse and repeat the process by buying another property or working with your tax strategist and making sure that you are planning so that you make estimated payments throughout the year. Again, we help clients with tax planning all the time, not just tax preparation. I hope this information was useful because there's so much information about what the short-term rental is, but I wanted to give it to you guys in a more precise, shortened video with the 3 steps that are needed. So let's recap really quick. Number 1, making sure that you buy a short-term rental. Number 2, materially participating. And number 3, making sure that you have on average 7 days or less stay.